Welcome to SprottMedia.com. I'm joined by Rick Rule of Sprott U.S. Holdings, and Rick is in town for Mines and Money New York 2018. Now, mining companies, investors, service providers, and industry experts are gathered here in Midtown to connect. Keynote speeches and panel discussions are also taking place at the mining investment event. So without further ado, let's talk about exploration. Now, Rick, thank you so much for joining me.
Pleasure to be with you, Remy.
Well, a lot of people will be here in Midtown and they'll be talking about commodities. So first and foremost, I want to get your take on what we're seeing in terms of the bigger picture for commodities and commodity equities.
We're in an interesting and I think favorable space. The commodity prices have done very well over the last 18 months, much better than people expected. But the equities haven't kept pace, which means you've had very strong commodity prices, and you have commodity prices that have impacted in a very positive sense the producers of commodities, but the equity prices of commodity producers haven't kept pace, either with commodity prices themselves or with the cash flows that they've generated. An example would be the oil price, which has moved from $45 to $70, but the shares of the oil producers haven't kept pace despite the fact that their earnings are in fact soaring. My suspicion, my hope too, is that the equity markets play catch up with the commodity prices, something I fully believe will happen simply because of the cash generating capabilities of commodity producing companies.
And Rick, it's very interesting. Every day we see so much volatility in the equity averages, but we're also starting to see this divergence in gold. Now, at the Mines and Money conference you'll be speaking at, there'll be a lot of experts talking about all sorts of commodities, not just gold, but diamonds, silver, palladium, platinum. And I know you're a gold bug, so what do you make of the divergence we've been seeing in the traditional relationships for gold?
Well, certainly the gold market is interesting right now. I would argue that gold has done reasonably well in the last 18 months, given the fact that gold normally does well in periods where confidence has been lacking. The overall equities, and in fact the debt markets too, have been very strong in the last 18 months. I would argue with you that confidence has been strong and gold has done well, which is something that I don't normally see. You also need to be nervous as a gold aficionado about a strong US dollar. And one would argue that the fact that the interest rate has gone up might strengthen the dollar. But the fact that gold has done well in the last 18 months is, I think, extremely encouraging. One explanation might be that speculators are concerned about the aggregate debt levels in the United States and concerned about what that portends for the future. One would suspect that the lack of volatility that we've seen in the last 18 months has to do with liquidity, the fact that there's a lot of cash in the system. And one would suspect that the strength in the gold price, the relative strength in the gold price, might have to do with the fact that very large investors, the Ray Dalios of the world, are concerned about the difference between liquidity, that is cash in the system, and solvency, that is too much debt. So I feel pretty good about the gold price, given the confidence that's still baked into the system.
And Rick, I know that you never talk about prices for gold per ounce, but we do seem to be sort of range-bound right now between 300 and 1360. But I do want to get back to what you're talking about at this conference. So let's talk about the exploration investment landscape and what you think could be done to improve what we're seeing. And I know you're an expert on the prospector generator model. You recently hosted a webinar on this, and you got a good reception. But what do you make of what we're seeing in that model right now?
I think it's an attractive space to be. Maybe it's an attractive space to be for me because I've done it for 40 years, and I understand the landscape. Many people misunderstand the nature of exploration. They think that these small companies are asset-intensive businesses. I have an advantage, I guess, being from California. I think that they're intellectual capital, research and development businesses. And I think that the exploration team, the scientists, are probably the most important businesses. You analyze them the same way that you would analyze a software business or a biotech business from my point of view. The second thing then, if it follows that it's more of a process-driven business than an asset-driven business, is the business plan. And that leads us to prospect generators. Very much like small companies in biotechnology or software, the correct business plan is to generate the investment thesis and then very quickly partner it with a larger company that carries the capital risk associated with the development of the project, so that the prospect generator, the research and development team, focuses itself on the intellectual rather than the physical capital. It's interesting to note, and I'm glad you asked me the question, the overall probabilities in exploration, like in research and development, are very low. But what you find is that certain teams so far outperform the averages that the goal of the investor is to associate himself or herself with the best of best teams, understanding that over time the process will work if you do that. That's what's worked for us for 40 years.
And Rick, last but not least, before I let you go, we do have the Sprott Natural Resources conference coming up in Vancouver, Canada in mid-July. I'm sure you'll be talking about gold, the prospector generator model. But before I let you go, since we're sitting here in the middle of Times Square at the NASDAQ market site, every day we have the opening bell as well as closing bell here, and there are a lot of IPOs. But when it comes to natural resources, private placements are very important. So in a nutshell, can you tell me what you've seen so far in terms of private placements?
Yeah, absolutely. I would say that there's an old acronym on Wall Street called, that an IPO stands for, it's probably overpriced. And when the time comes that natural resources are as popular as other sectors, we'll have lots of IPOs too, which suggests that that's the right time to exit the market. There's another old Wall Street maxim that says, when the ducks are quacking, feed them. That means that when a sector is very, very, very popular, you trade paper for money. We will go back to an IPO phase in resources, which was a time when smart speculators would leave. Now, private placement market is very different. That provides additional capital, supplemental capital, to companies that raised money at higher prices when the sector was popular. The private placement market is generally a more sophisticated market. Moving on to the question about the conference, this is the 29th year, I think, that this conference has existed. I would suggest that in terms of the more speculative parts of the resource market, that is the hardcore exploration focus, that this is now, this being the Sprott Vancouver Natural Resources Investment Conference, probably the single best conference in the world for sophisticated speculators in exploration worldwide. It takes place, July 17th through 20th, has a range of keynote speakers, Jim Grant from here in New York, Jim Rickards, David Stockman, the ex-director of management and budget, myself, as well as 80 of the best exploration companies in the world.
Well, Rick, thank you so much for joining me, and we'll see what happens to commodities next time we meet in Vancouver. Thank you very much.
I'm certain we'll both be smiling.